What we want to talk about today is we'll cover a couple things that I think everybody is already very well aware of, and that's really the state of water infrastructure in the U.S. And really, we want to mention a couple specific observations there, and then we're going to talk about one solution to address those. So what we want to cover is capital acquisitions and one creative solution that's out there. Installment purchase financing may be to you, but it's kind of evolved a little bit, and there's some nuances and some tweaks, if you will, that have been done to it that make it tailored more to the water industry. And we thought this would be a good venue to cover that and get that out to everybody, so folks are aware of, what is it now, what's it look like, how has it evolved, and what are some of the benefits and options and things you just need to be aware of when you're trying to source those financial solutions for your capital needs. Then we'll talk a little bit about going about selecting a partner. There's certainly a wealth of lenders out there, and so we just kind of want to educate folks on some of the questions to ask to help you qualify who you're going to with, and equip you with some of the right questions in order to get you through that selection process. So, as many of you are aware of, I don't think it's any big secret that the water infrastructure in the U.S. is in sore need of improvement, and a lot of that improvement is going to cost a great deal of capital. In the 2014 AWA report, talks about a 4.6 on a scale of 1 to 7, slightly up from a 4.5 in 2013. So really, not a great deal of improvement, and demand just continues to increase. I saw something a while back, I think it was one of the EPA little stories. It talked about how 100 years ago, the average American used 10 gallons of water a day to drink, cook, clean, and bathe. Now that tells me there wasn't a whole lot of bathing going on in 1914, but it also tells me that today, where we're consuming over 100 gallons a day per person, demands have increased dramatically, and the systems just really haven't kept pace with that. And we'll only get you so far, and there's a big capital need out there to update and maintain. So down there at the bottom of the list, you can see number 3 is financing for capital improvements, and I'd argue that the first ranked item there, state of water and sewer infrastructure, is really the driver for that, right? Because the reason why it's in the condition it's in is because of past lack of investment and really, a reluctance by the general public to pay on a full cost basis what is really needed in terms of rates to cover the cost of delivery. And so, what we've seen is a lot of folks coming to us and saying, we need a creative financing solution to get our system up to speed, to catch up with the improvements, and do it in such a way that it minimizes the impact on the users, but still allows us to accomplish things through through a rate system that works. And it's some of the needs are so dramatic. There was one, I think it was Milford, Massachusetts, I saw, where they were talking about an 83% rate increase in order to pay for a $25 million new treatment plan. And that's a dramatic jump, obviously, and none of us wants to be in that type of position. But rates and those things need to be adjusted, and we all struggle with and palatable to the public. But again, to get back to the size of those, you and I going out and buying a house, there's not too many people that could just write a check for that. Most of us need to find a borrowing mechanism that works and allows us to get there. And I guess the conclusion to walk away from the survey and all the other things we've all seen is that it's a difficult task, and what we wanted to talk about today was one potential solution there. So while we go through this today, we're going to do this on somewhat of an interactive basis and do some polling. And so this is our first question. This will kind of help us tailor the conversation. But what are some of the biggest hurdles for organization and funding projects? And the options are A, available budget, B, the approval process, C, cash flow, or D, other. So if you'll take a minute to answer the question, and again, what are some of the biggest hurdles in funding capital projects? And that's A, available budget, B, approval process, C, cash flow, or D, other. And Beth will chime in and share those results with everyone.
All right. Well, great. Well, we're going to give everybody just a second or two here just to get their poll answers in there, and you can just go ahead and click on the screen for that, and it'll come through straight to me. And let's see here. I'm going to close out our poll and take a look. And interesting. Well, it looks like, Brian, we've got 67% of our audience answered A, available budget, 14% answered B, approval process, 11% answered C, cash flow, and our last 8% came in at other.
All right. Thanks, Beth. Not surprising. Everyone's budget is pretty stretched. So thank you, everybody, for participating in that and sharing that. So let's go on and let's talk about one potential solution. And as I mentioned in the opening, a lot of you have probably seen installment purchase financing. There's a variety of other names for it, lease purchase financing. So let's talk about really what it is. And really it's not unlike the house analogy that we had earlier, or you and I buying a vehicle. You know, it's making your payments over time and achieving ownership. And there's some variations on that, but and like a vehicle, it's changed, right? Installment purchase in the past, it's evolved to where there's some tailored opportunities or options for water, and so it's, as the saying goes, it's not your father's Oldsmobile. It's kind of new, and there's some new twists, and that's what we want to talk about. Is more of a specialized instrument that that you know, was done through folks taking the time to understand what are the unique demands of a typical utility or you know, commercial water entity, and how can we create a mechanism to allow them to borrow that reflects all those positive attributes. So we'll go into that in some detail, and then part and parcel to that comes the components that are pulled from traditional borrowing. I don't think there's too many utilities out there that haven't issued a bond at some point in time, but that process can be kind of clunky and somewhat cumbersome. And while it has its place, because as a lender we do those as well, and you know, we have some extremely large opportunities that definitely fit that. But there are more nimble products such as installment purchase that can extract some of the features of a bond, integrate them, and come up with the same type of interest rate structure. So pretty beneficial to take a good look at it. And then it's a lot more simpler and less expensive than your typical bond approach, because you don't have all those costs of issuance that go with it. You also have a much shorter time. To give you an example, we had a property, they come to us, and they had done everything that they needed to do, but their current partner was struggling with a couple of the issues. So they called us up on the 25th of the month. It was about a $30 million acquisition. And they called us up on the 25th of the month and says, is there any way you guys can help us? We'd like to get it done by year end, and it just happened to be December. And we were able to pull that together, do our due diligence, and work through that and get them done by fiscal year end. So I don't think there's any way you could get a more cumbersome bond type financing done in that time frame, but by using this installment purchase methodology, getting their attorneys involved to the extent needed, and working with our staff here internally to move. And then really it's designed to be a replicable type tool. So we'll talk about that and how start off with more of a master type schedule and a master agreement, and then you can add schedules to that. And anecdotally, there was we worked with a municipal authority, and they started out, and first they needed meters because their meters were extremely old, and they had a whole lot of leakage that was taking place at the meter level, unaccounted for water. And so they started off with that, and then that in turn allowed them to free up some cash to do a water tower, and then a whole lot of equipment, construction equipment for pipelines and things. And then we also ended up doing a new maintenance facility and just a number of different things for them. And it all started with that base agreement, and that's kind of what you're looking for, is that type of benefit that saves you a little time and allows you to go to the business of taking care of the utility and not wasting a whole lot of time on a finance that is merely a means to an end. I mean, we realize that as a lender that, you know, for our role is to help you accomplish your goals, and that the borrowing is just a vehicle to get there. So let's go a little bit deeper into some of the advantages. Most of these are typically done on a tax-exempt rate if the borrower is eligible, and you know, it's just the content of the document that allows you to do that. There's all kinds of local and jurisdictional type attributes that are incorporated in there. Most lenders you're going to want to work with are going to operate on a national level and should be aware of those nuances, but you know, that's another good question to ask that we'll talk about later. The flexibility that we just talked about, you know, a master agreement, the ability to add things, and also to change them, because sometimes midstream you may need to do some things, and you're going to want that flexibility, and typically an installment purchase type structure already allows you to do that. And then the final thing is keep the costs down, and again, a lot of the conversation we'll have today is a comparison to bonds, which has been the typically used method for borrowing. But again, there's a whole lot of fees that can go with that, and if you can avoid paying those fees, then you know, then it's worth looking at and looking at your total cost of the borrowing, just like you look at the total cost of providing water to your customers. So here's an example of another situation. This was up in the New York area, and they needed to borrow for a number of different improvements, as you can see here. Station improvements, some pumps, coag basins, and it wasn't a huge deal, but you know, sizable, $12.5 million. And we were able to work with them and relatively short order. They had a number of outstanding bonds, and they've come to us and asked us to restructure those, which is something else that we do. A lot of times we'll do new issuances and roll in older issuances, and most lenders will do that for you. And it's one of the things you want to look for that we'll talk about in terms of questions is prepayment capability. So the results for this particular customer, it saved a great deal of time. We got this done inside of a month, and they compared it themselves to their bonding process and found it to be a lot more cost effective. And it enabled them to add soft costs and other things that had a shorter lifespan. And so that's another consideration, is what's the useful life of the improvements that I'm putting in, and how does that compare to the term of the financing? You know, you don't want to pay for something over 30 years that will be used up and gone in 10 years. So a couple more comments on the comparison. So when you're looking at bonds, there's a couple different things that really jump out at you, and one is the length of the document. I've been in municipal borrowing for close to 20 years, and as I mentioned, do bonds as well as installment purchase and lease purchase and pretty much every single flavor in between. And going through the bond documents, we end up with these big 3-ring binders, and there's a lot of paperwork and a lot of work that goes into that. And because of that, there's a lot of attorney's fees and other things. And typically, if an installment purchase is papered out correctly and done in an efficient manner, you're probably talking about a 15 to 20 page base document and then a 5 to 10 page schedule document. So it's pretty nimble. It's something that your in-house legal counsel can typically get their head around quite easily. Legal opinions are required on tax-exempt deals in most cases. And it's just a more nimble document to borrow against. And because of all that paperwork, speed is also kind of a function of that, where you're able to get it done more rapidly. A lot of times on the bond deals, we go a couple months at least with team calls and drafting and redrafting, and sometimes you have to make sure it's compliant with additional debt, and you have all this other work that has to be done there. So it just extends the time frame. And then approvals is an important issue. I've seen folks where they anticipated doing a bond issue and they put it out to the public and the public voted it down, and then they tried to borrow in another manner, and it raised a question of whether or not they were going against the voter approval or voter wishes. So you have to be careful with the bond referendums because if you do get a situation where it's not voted for, you're kind of limited in terms of some of the alternatives sometimes that you'll have at your disposal. And with installment purchase, especially when it comes to a water authority, if there's the ability to pledge revenues because it's part of an enterprise fund, typically the board has that purview, and then some are done if they're not in an enterprise fund and they're just part of a general fund, then they're typically done on a non-appropriation basis. But the best route to the least expensive money in terms of borrowing is typically done under a pledge of revenue scenario. So I mentioned earlier that this kind of new generation of installment purchase for the water industry reaches over into the bond world and grabs some of those positive attributes that give a lender greater comfort, and therefore that greater comfort manifests itself in a lower interest rate and a lower cost of funds. So some of those things are, where it may contain a coverage ratio that at all times you'll maintain a 110 or some level of coverage to the debt. And that's important because the looks at that feels like we're here. They always have 1.2 coverage of all their debt and all their expenses, including my payment. So that's one of the attributes that is often incorporated in this new version of installment purchase. One might be a rate maintenance covenant. And the rate maintenance covenant kind of goes with the debt coverage ratio requirement, where if you start to drop below that 110 or whatever the number is been established, you agree to raise rates in order to maintain that coverage. So while there may be some unforeseen circumstances that happen, maybe you have an extremely wet summer and ordinarily a lot of your revenues come off of folks watering yards and it allows you to adjust for either seasonality or just to adjust if for some reason you've ordinary expenses. And that benefits both the again, it benefits both parties because one, it's a covenant that you can lean on and say, well, our debt requirements have us maintaining a 110 or 115 or whatever the number is. And it's also healthy for the utility to have that type of coverage ratio. Another thing that's possible, but it's not always required, is a debt service reserve. And the tax code will allow you to borrow 110% of a project cost and house that additional 10% in what's called the debt service reserve, or DSR. And how that works is, let's say your payments are semi-annual, which is pretty typical, and every 6 months the interest would be stripped off of that debt service reserve, and it would be applied to the payment, and then the utility makes the balance of the payment. And that debt service reserve is there in case you end up with some dramatically unforeseen circumstance and a payment cannot be made. You're able to reach over into the debt service reserve, make the payment out of that amount, that additional 10% that you borrowed, and then adjust rates and kind of readjust things in order to replenish that DSR over time. So it really keeps payments from being interrupted, and it also prevents a default. There are folks out there that will assert, folks in the legal profession that will assert that touching the debt service reserve is a technical default, but typically when these transactions are papered, they allow for touching of the debt service reserve and utilization of those funds without triggering default provisions. So it's a nice enhancement for a credit that maybe has struggled, maybe it's trying to reestablish itself, and there might be some unforeseen events, or they're so stretched that an unforeseen event is crippling. So by borrowing the additional 10%, you're able to weather those types of unforeseen circumstances. So again, helps the get more comfortable, provides a cushion for the borrower, and all of that manifests itself in a lower cost of funds for the borrower. There's also a variety of end-of-term options, and while typically in almost every single case on a tax-exempt borrowing, you'll have a dollar out or you'll solve to a balloon payment, there are other options. And you may have a desire to access the OPEX operational side of your budget versus the capital side. And in that case, there are some fair market value opportunities out there. And while you cannot do a tax-exempt lease on that basis, there's nothing that precludes you from borrowing for 5 or 10 years on an asset, and it has a residual amount. And then at the end, you have the option to turn it in. You could pay the fair market value, or if you decide to keep it and necessarily have to pay for that fair market value purchase, you can always refinance that and extend the term. So a couple different options. They're just good to know and good to be aware of when you go in there. Sometimes I've seen lenders put together, maybe it's a 15-year amortization, so the payments are based on a 15-year term, but at year 10, the remaining years are accelerated into a balloon payment. That's an option too, where you amortize over a longer term, but it's actually a shorter term financing, and that may be an option for some folks. And then when year 10 rolls around and you have that balloon payment, a lot of times the borrower will say, rather than pay for that, I just want to extend it or borrow that amount from you. So just good to know that variety of structures, and a lot of times the end-of-term options are dictated by those structures. So we have another quick poll we'd like to do here, and I'll have Beth jump on the line after I read the question. But we want to talk about the overall capital needs. So all of our budgets are kind of stretched, but let's talk about kind of the range of the needs that folks on the call have. So the options are less than 10 million, 11 to 25, option C, which is 26 to 100, and D is more than 100. So again, what are your organization's current system capital needs if you were to target optimal performance? A would be less than 10 million, B would be 11 to 25, C would be 6 to 100, and D would be more than 100.
All right, well, good. We'll give our audience just a couple more seconds here to get their votes in. So again, you've got options A through D there. How much capital do you need for your organization's current system to achieve optimal performance? So go ahead and click on the screen there, and we'll get your votes in. And let's see, Brian. Well, it looks like we have 33% answered A, less than 10 million, 31% answered B, 11 to 25. We have 27% at C, 26 to 100, and our last 9% comes in at D, more than 100.
All right, thanks, Beth. So pretty evenly split on A through C, and obviously different size utilities, different requirements, but interesting is that across the board. I'd love to be in that less than 10 million position if I were on the line. So let's talk about going about and really choosing a partner. You know, it's kind of tough to. There's so many lenders out there, and while I think we can all agree money is a commodity, it's part of the equation is lowest rate, and obviously that's what you want to solve for. But it's also about what comes with that, right? How many hooks are in there? What are all the requirements? What types of reporting do I have? Rate fixed? Is it variable? How can it change? When can it change? I mean, there's a whole lot of different questions to ask. So what we wanted to do is try to talk about, because it's definitely not a one-size-fits-all. Everybody's needs are unique and different, and you're going to want to source somebody who can help and who can understand what your particular needs are. So I'd say the first one is expertise. In order to put together a financing that works for somebody, that lender needs to understand how your utility functions. What are the unique needs of a water utility? How do those capital improvements translate into benefits, and what are the savings? I have the benefit of in my current role of overseeing both our water efforts and our energy efforts. And over the years, I've seen a lot of synergies between the two, and you know, some cross-pollination. So it's easy for me to look at what the improvements are and see an energy savings, and also see maybe some efficiency savings in terms of operations, and put that together. And you know, you're sure that whoever you're speaking with has some understanding of your utility and what the improvements are going to do and what the benefit is, because essentiality is core to most lenders. They want to know it's something that's going to go in, that's going to have a stickiness to it, as they say, and not something that you can easily remove. And in order to understand that and get there, they need to understand how that works in the overall system of things. So the other thing that we think is important is flexibility. You know, is there flexibility with term? Maybe I have a bond that runs out for another 3 or 4 years, interest only during that time period until I'm out from underneath that. Or do I have some extraordinary expenses that I have coming up, and I need a little bit lower payment to start off with? So maybe it's like a step up type payment over a period of years. Will they do construction financing? If so, what does that look like? If they just do the construction financing, can I get them to commit to taking out and putting the term financing in place And can I get them to do that today? So if I have a 10 or 15 or $20 million project and we do the construction, do I have my solution in place to take that out? Because different lenders have different tastes for the risk that's associated with construction. And what types of collateral requirements are they wanting a first position on all my assets? Do they want are those encumbered by perhaps another borrowing? In the case of where there's another bond outstanding, a lot of times those assets are already pledged. So how do I get how do I get a lender comfortable with that? So what are they going to ask for in terms of collateral or other pledges? And some are a lot more flexible than others. I've seen some lenders who will look at a water tower as a piece of real property, and they don't lend in the real property space. And then I've seen other lenders who look at a water tower and say, as long as it's not a composite tower, like a leg tank, and say, okay, that's something I can disassemble and resell, because there's folks out there that'll do that. They'll take them down, refurbish, and resell. So they'll look at a water tower as equipment. So what are their asset management views on certain types of assets, concrete versus equipment, and what falls into each bucket, and how willing are they to loan against the different types? The next side is efficiency. How fast can they get this done? And speed's important, but you also want it done right. But you also don't want to wait 3 months for the financing to be put in place and for your funds to be available, especially in a market where rates are ticking up. A lot of lenders will allow the rate to float until the final paperwork is done. And when you're taking months to put it together, it puts the utility at risk, at that market risk. So you want someone who's gonna be able to work efficiently. And I would argue that one of the questions I would ask here would be, what's our anticipated funding date, and how can we work back from that date with the deliverables, and how do we insulate ourselves from market movement? So just a couple things there that are associated with efficiency. It's not just how fast they send you the documents, it's how fast they complete their credit due diligence and underwriting of the overall transaction, assessing the assets, their value, and putting it together for you. And then next to last here is support. And so it's all well and good when the financing is done, but that's just the beginning for you, because now the assets are probably being ordered. If it's a construction financing, there's milestone payments that need to be made. Various contractors need to be paid. So what kind of support are they going to provide you? Do they have the back office support? Are they experienced with evaluating those construction draws? Were those construction draws agreed to beforehand, and what would be required? So some of this sounds like very basic components, but you'd be surprised that sometimes it gets down to the after funding process, and funds are sitting in an escrow account, and getting those monies to flow through to the contractors to get your project done can be a cumbersome process, and you want to make sure that everyone's paid promptly once you've said that the work's been done, and they should be paid. And the final one is stability. How long have they been around? Have they loaned in the space before, which is a little bit of the expertise function in the first bullet, but how far back do they go with their experience? And so you're going to want to ask them, how have you focused in this area? Is it an area you're committed to? Will you be around tomorrow for my next borrowing? Is it a space you're going to continue to lend in? How big is your commitment to the industry? Gauge that is to are these folks that I see at my trade shows? Do they support my groups? Are they members of the associations which I belong? Things like that just are good signs to look for. So here's a number of those questions that we talked about. We thought we'd get into it a little bit more specifically and talk about the before side. So, you know, when you're in that initial of you've assessed that you need to borrow, now you're talking about sourcing a finance partner. And so we're going to go through the before, during, and after here. And so as you're out there talking to them, you know, obviously you understand how you're going to use the technology or the assets you're going to acquire. But, you know, being able to communicate that to somebody who understands, does the finance rep know my business? Does he know the benefit? You know, is it somebody that's already has some familiarity with you guys personally, you know, your utility, somebody that understands the industry, who can readily, you know, readily get their head around the project and the need for it. Soft costs can be a big issue for a lot of lenders. A lot of lenders are purely asset-based lenders, so you want to make sure that some of the soft costs can be included. I recall we did a large meter installation. I think it was around 30,000 services, and so it wasn't huge, but it was a good-sized project. And they wanted to use, that utility wanted to use its own labor to install all the meters, and so they wanted to hire additional workers to do that, put in the meter boxes, the meters themselves, all of that. And then they had a software cost with the billing system, and they had been told no by another lender that they, you know, they were unable to cost, and the firm I was with at that time, we were able to get it all done on a tax-exempt basis, and allow them to, or enable them, I should say, do it that way. So you want to make sure that that flexibility is there. You know, you know, during the financing, these are the questions you want to ask about what happens when I'm in the financing. So, you know, a couple of these, what happens if I want to change this finance agreement? Or if you take out your a lot of transactions, typically a lot of bonds, and read them, they'll have maybe on a typical 30-year bond, you might have an early no-call provision that's the first 5 years or so, where it just simply cannot be prepaid. There is an animal called the defeasance out there, which involves parking the money to make all remaining payments, but let's not dwell on that one today. But it may have a no-call provision, and then maybe there's a 3% prepayment premium for a while, and then after 5 years it drops to a 2, and then a 1, and then there is no prepayment. Others have a prepayment penalty that lasts all the way through. So you're going to want to know that if you end up with a windfall or interest rates drop dramatically, that you have the opportunity to refinance. Another one, how am I responsible financially if the equipment is damaged or destroyed? Most utilities are self-insured, but obviously, you know, you want to make sure that you're covered in the event an asset gets destroyed or some unforeseen event happens. The one in the upper right, total monthly payments and additional costs. A lot of times transactions come with annual fees. Those annual fees may be a trustee fee. There may be disbursement fees or escrow fees. There's a balance, there's a charge. You know, you're going to want to ask those questions about during the life of the financing, what other expenses can I expect? So there's a couple other ones here, and I realize we all can read, and the slides have been up for a while, so I won't go into them. But just good to know that, you know, the answers to these when you're selecting that finance partner. And then we have some questions to ask about the after side. You know, at the end of the financing, what do I have to pay? Or, you know, if it's a fair market value transaction, what's that look like? What's the mechanism for determining that fair market value? A lot of municipal leases are $1 out. The dollar never actually changes hands. It's part and parcel to the final payment. But, you know, are there any costs associated with releasing security interest in the assets? Are those passed along to you, the borrower? So, you know, good things to know about the end of term option. And then the options themselves that we covered earlier, right? Do I get to keep it? You know, can I refresh midway? If I do, how does that work? You know, just a number of different solutions that you want to be aware of. So we'll do another quick poll here right before we head to a wrap up. But I want to talk about what type of project or equipment is most critical to your organization. Is it A, access to water, B, storage, C, metering, D, loss detection, or E, treatment? So again, what type of project or equipment is most critical to your organization today? What's your most current and pressing need? Is it A, access, B, storage, C, metering, D, water loss detection, or E, treatment? And Beth will tally those up for us.
All right, great. Well, a couple more seconds there to get your votes in. This is our last poll for the webinar. We will be doing our Q&A in a little bit here, so if you have questions, you can send them in there as well. So let's see, we've got a couple coming in, so the last couple seconds for that. What type of project/equipment is most critical for your organization? Options there are access, storage, metering, water loss detection technology, and the last one there is treatment. All right, well, great. Well, I'm going to go ahead and close these poll and bring our results up for everybody. And it looks like we've got 42% of our audience answered treatment, 20% of our audience answered storage, 15% were at water loss detection technology, 14% at metering, and our last 9% today was at access.
All right, thanks, Beth. Interesting, and the doesn't surprise me. The storage taking second place is a little interesting. There's been a whole lot of new storage in recent history. I know during the boom that we did a lot of water towers, but I haven't seen as much done lately. So interesting. All right, so we'll just kind of take a quick minute to summarize things here. You know, depending on what you read, whether it's $1 trillion or $2 trillion or whatever the number is, I think all of us feel that, and I think it's supported by the poll, that we all need some improvements in our systems. I don't think there's very many of us out there who have a system that's operating at a fully functional, optimal level. Between unfunded mandates and increased demands and change in constituents, there's just a need everywhere. And you know, the need to put that in place obviously dictates a need for financing, and you know, nothing happens without funding, and that funding has to come from somewhere. And while the Fed makes its efforts, and there's some mechanisms out there, some take longer than others, and some have some great term and extremely low rates and longer amortization. The line is to access those, and sometimes, you know, you can't wait, and obviously there's not enough money there to go around for everybody. So finding different financing solutions is pretty obvious. And then the final one, you know, taking advantage of changes in technology and changes in financing. I think it takes a combination of both. Financing is a very, very old business, right? But there are some nuances and there are some new wrinkles on things that I think it's important to be aware of, to investigate, see if they're a fit for your utility, and see if there's a way to leverage them into into some efficiencies by utilizing it. It's just another tool. And then on the finance side, just to kind of summarize what we talked about on the installment purchases as one potential solution worth considering. Don't just accept an off-the-shelf product. Ask those questions that we talked about and see what's been done within that structure to tailor it specifically to your utility. Allows that access in a timely manner and in the way that you want it, because believe it or not, as the borrower, you are in the driver's seat to a large extent, and I wouldn't be afraid to ask, especially in this market. There's a lot of lenders with a lot of capital reserves who are looking for things, and with rates being as low as they are, there are a lot of lenders out there still looking to loan to folks, and so there's a lot of money chasing very few deals, as we like to say around here, and it's a great time to be in the market looking for funding. Make sure that it's done efficiently and timely, and make sure it's got that flexibility for you. It's got to be something that works and that's easy to use, and something that should be replicable, right? So you want to have it where, in an ideal world, there's a master agreement, and then as your capital needs come in, and maybe it's quarterly, you ask for a schedule, or say, look, I need X amount of dollars this quarter for these minor improvements, and that's running parallel with your larger project improvements, and just use that financing as a tool to help you manage your budget and plan things out and look long term, and use it to get your utility where it needs to be. So with that, I'll turn it over to Beth. That concludes my portion of it, although we'll open it up for a little Q&A, and Beth will take care of the house cleaning items.
All right, well, great. Well, thank you so much, Brian. And yes, just a couple housekeeping items before we start today's Q&A session. First, your feedback is important to us, so please take a minute to complete the short survey, which will pop up after the webinar is complete. Second, prior to the webinar, we emailed a link of the presentation. If you did not receive it, please contact Zach at ztrafny@forester.net. Third, the webcast version of this webinar will be available for your viewing and for viewing by others. If you missed any part of the webinar or would like to view it again, you may do so via the link, which we'll email out tomorrow. Also, feel free to encourage your coworkers to view this webcast, as it will be available at foresteruniversity.net for the next 12 months. We will also be emailing out certificates to those of you who stayed the length of the program. If you do not receive a certificate, please contact Zach at ztrafny@forester.net. If you have joined us in a group with additional attendees who have registered, please send your attendance form to Zach after the webinar. If you have a group listening in, maybe with additional attendees who have not yet registered but would like CEU PDH credits, you can also go ahead and contact Zach after the webinar. He'll get those registered for you. And with that, I'll go ahead and put up Brian's contact information and information for our upcoming webinars, including our Communicating the Value of Water webinar presented by returning speaker Melanie Getz on January 21st. Our Backed by Popular Demand Voodoo Hydrology webinar presented by Andy Reese on January 29th. Our Introduction to Russell II webinar presented by Terry Toy and David Lightley on February 25th. And our Designing Effective Sediment and Erosion Control Plans for Roadways Projects mini-series starting next week on December 10th with Jerry Fifield and Tina Wills. Also, make sure to check out our on-demand library, which has over 150 webcasts, including this webcast for the next 12 months, as well as our recent bestseller, Fluvial Geomorphology 101, presented by David Williams. All of these are available at forsteruniversity.net at any time. And with that, we'll go ahead and open it up for questions here. And my first question comes in from David, and David's question asks, how can I find the right financing provider for my organization?
All right, David, thanks for the question. You know, I would look, you know, you could start looking locally, because there's a lot of local banks that do have interest. And that's a good place to start. It might be somebody that knows you. The other thing to do is to look at some of the financial sponsors for some of the larger events, like Tekanawa, you know, their conference there in Boston this year. Good place to look and see who was in attendance. Those are best lenders to speak to, because they're proactively seeking borrowers in the space. Publications too, any stories that you read. There's a lot of press releases that go out that talk about lender activity, doing this project or that project. Those may be another good source for you.
All right, great. Well, great question, David. Let's see, a question in from Anne, and Anne asks, is water infrastructure project financing available in all states?
All right, thank you, Anne. Yes, there aren't any states that preclude it. Jurisdiction nuances that are taken into consideration. There's a couple states that have some very unique requirements. New Mexico is one, as is Idaho, and the code in Louisiana is a little bit different. But all states offer some form, some iteration of borrow for water infrastructure.
All right, great. Well, good question, Anne. Let's see. There's a question here from Elizabeth, and Elizabeth asks, are there any restrictions on the types of projects or equipment that can be financed?
Okay, sure. And it's a great question, because sometimes there are consumables that are a heavy component of a borrowing. And some lenders struggle with that, and this is where the structure of the financing becomes important, because you know, maybe you have an asset that has a useful life that is shorter than the desired financing term, or there's a component or two within that asset that you know, maybe it's membranes in an RO system or something like that. And some lenders struggle with that, and if you have soft costs, or you have anything that that has that attribute to it, that's where kind of shifting the structure a little bit and getting a pledge of revenues and doing it on more of a note basis rather than an equipment-based lending, or maybe it's a combination of the two, allows you to get where you need to go. And now, obviously, you need to ask yourself when you're entering into that, you know, are those the types of things that I really want to finance, or should I pay for some of those out of pocket? But generally, if there's the intent to achieve ownership and it's essential use, generally there's a good mechanism out there for sourcing the financing. And that's, again, that's where that experience item that we talked about earlier, and the awareness of any restrictions or subtleties within an acquisition that cause concern, that's where that experience comes into play, because then they can suggest an alternative that might be a little bit more effective that addresses that potential restriction.
All right, great. Well, thank you, Elizabeth. All right, well, we've got a bunch of questions in the queue, but of course, if you do have a question, go ahead and put it in here, and we're going to work through as many of these as we can today. Our next question is from Dendra, and Dendra asks, at what point do meters become cost-effective? For example, how many return more cash than it costs to install, read, and maintain them?
Okay, Dendra, thanks for the question. I'm a big fan of keeping your meters at the optimum level, and I'd have to defer to the meter industry to comment. What we typically see is guarantees around 10%. 10-year accuracy, and there's obviously different meters and different types out there. So I would defer to those folks. I don't want to speak about any one particular product, but I mentioned the 30,000 services that we replaced. To go into that a little bit deeper, for that utility, I think they were at 93%. That 7% doesn't sound like a whole lot, but they crunched the numbers out, and given their consumption levels and given declines, 1% per year is kind of a commonly accepted number depending on the age of the meters once they're over 10 years old. They figured out by replacing them all at once, and obviously you can't just pop 30,000 meters in the ground immediately, but over like a 6-month period, that the system would pay for itself in about, I think it was 39 months. So it was a very quick turnaround before they were in the black. And the reason why I'm such a big proponent of meters is, obviously they're the cash registers of the system, and it really allows you to maximize the revenues that you've got. You still have leakage issues, but it allows you to pinpoint those a little bit more readily, in my opinion. And so I would say that loss is, realize you're losing that amount every single day, and it probably increases as time goes on, and factor that in and see what that translates into in terms of a payment. So did some financial modeling. It'd probably be pretty quick to run out and say, all right, at what point does it make sense for me to replace my meters?
All right, great. Well, thanks for that question, Dendra. Next question is in from Douglas, and Douglas asks, do these discussions equally apply to flood control or stormwater management improvements?
Yes, yeah, and we talked a lot about just certain segments, but the same borrowings and mechanisms are available really to, the only line here is really tax exempt versus taxable. And to borrow at a tax exempt rate, there's certain guidelines, and it's really a statutory power. So whether it's a special district, maybe it's a utility authority, there's all kinds of flavors out there right across the country, and different states do it differently. But yes, all of these solutions are available to special districts and other similar entities.
All right, great. Next question I've got here, let's see, is from Andrew. And Andrew asks, are most lending institutions familiar with these installment purchase financing?
Andrew, that's a good question. I've seen folks that I thought should have a strong awareness of the product that didn't have any idea about how they work. And then I've seen other smaller, what I thought would be a less sophisticated type lender who completely understood how they work. I think where you end up with some issues is a lot of times when the lender doesn't really understand it, and then the borrower has questions, and because the lender doesn't understand, it ends up being a big issue. So I guess my my response would be to say, yes, there are many who know, but no, not all of them are aware of it. I don't think very many are doing this where you're integrating some of the bond attributes into the installment purchase. I haven't seen that as often as I'd like, because I think it's a great tool for the industry. And it's something that we want to push out there and present at other venues. But that's where I would ask those to say how many of this type of financings have you done, and kind of vet it that way.
All right, great. Well, Andrew, good question there. Let's see, Jennifer's question, she's has two in here, but the first one, what is the minimum your company would lend for equipment? Do you lend in Washington State?
Okay. Thanks, Jennifer. So two questions. The first one being the minimum. A commercial for Key, but I'll because it's asked specifically about our company, I'll just say real quick. We have small, mid, and large ticket capabilities, so we do transactions down to, $50,000, $100,000, and we typically do those within the context of a larger relationship. Do transactions up over 100 million, so it runs the gambit. So hopefully that answers your question on the minimum side. And then as far as Washington State, absolutely, it's actually one of the states that we have bank locations in, real estate in, and we actually have an office up there for Key Equipment Finance as well. So hopefully that answers your question.
All right, great. Jennifer's second question was, why weren't Mains on the list to finance?
No particular reason. It's not an area of focus for us right now. Mains are a little bit different. They're typically done on a bond basis because of the lack of portability. Most of the assets that we've talked about are things that have a degree of portability to them. They can be removed and resold at the end of term, cleaned up and refurbished, those types of things. It's more equipment based. When you get into water mains, then you're talking about something buried in the ground, doesn't have any value if you ever had a default and you had to go take the asset. You really couldn't do that. And so mains can be done. They're typically done on a revenue note type basis. They really fit into that bond side of things where the bond takes a security interest and a first position in all assets, and the fact that it's a pipeline is mitigated by the rights to all the assets and all the revenues of the system. So that's why pipelines were left out. We really kind of had more of an equipment-based focus today, but they certainly can be done. I'll digress a second on another thing, which is water rights and open storage like reservoirs. We didn't talk about those today. Water rights I've seen financed. I've done those before. Kind of a little unique, different animal as well, as is a reservoir. You're not going to repossess a reservoir really, and so that's why those are clearly non-equipment, more real property, and obviously rights get some different esoterics, but they can be done. You just need to make sure you're dealing with somebody who's done it before, because there's a lot of nuances and a lot of work that has to be done to paper those correctly.
All right, great. And Dendra had a follow-up to her question. She said, really my question is, how many customers does it take for metering to be cost-effective?
Oh, okay. Okay, I'm sorry, Dendra, if I misinterpreted your first question. It's a great question. I feel like if I were going to start with a clean sheet of paper today and set up my utility, I would want to meter everybody. I've done a number of rate studies in my past where that had flat billing. We're looking at going to metering, and I could tell you in almost every instance, they were overjoyed once they got their meters in, because it really gave them that visibility into consumption and rate setting and planning and all the other ancillary benefits that come with it. So I'm of the opinion that if you're able to, that getting everybody metered is a best practice.
All right, great. Let's see here. The next question comes in from PMP, asks, can a municipality have different finance companies or banks for the same project that may be broken up to different functions of the construction timelines?
Okay, Beth, I'm sorry, the first part of that cut out. Can you repeat that for me, please?
Oh, yeah, I'm sorry about that. Yes, so P asks, can a municipality have different finance companies or banks for the same project that may be broken up into different functions of the construction timelines?
If I understand the question, I would say short answer would be a qualified yes. If you have different lenders in a project and they're doing different components, as long as they're distinctly different components, it may all work when it's all put together. But for example, maybe one firm is doing the concrete elements of a wastewater treatment plant, and that's being financed by lender A, and then lender B is doing all the equipment components that are going to go inside that plant. So if I understood the question correctly, and correct me if I did not, you could have multiple lenders on the same project just taking care of different elements. I don't see any hurdles, although the revenue side of things and the source of repayment would have to be well defined for both parties.
All right, great. Let's see, a question from Ronald, and Ronald asks, is installment financing available to nonprofit, and in parentheses it says registered with the state, homeowners associations?
Yes, Ronald, it is. Typically, it'll come down to the strength of that HOA. I've seen financings done. Typically, tax-exempt treatment isn't available for that because they lack the statutory power. There are some nonprofits that have that power to borrow tax-exempt, and it's important to note that while you may be a tax-exempt entity like a nonprofit, you don't necessarily have the power to borrow at tax-exempt rates. But I have seen HOA financings done. Again, it comes down to the typically it's a credit type decision there, and the greatest or greater number of members in that HOA and the history there is important to show the revenue side. I've seen a distant cousin to that, which is like a water supply corp, where there's been some financings done there, and typically I've seen those in Texas and a few other places, and it's a widespread population and there's not as many members, but they still were able to qualify for borrowing just given how they were consolidated. The billing was consolidated, and I think that might extend, those same principles might extend to an HOA. So we just have to look at it on a case-by-case basis.
All right, great. And Ronald had a second question, which he asks, are you aware of state finance revolving funds? He says Washington State offers a drinking water state revolving fund for community water systems that are low interest, or 1 to 1.5% interest rate for 2014.
Absolutely, and if you can access those revolvers, it's a great thing to get to. So anytime, even though we're in the business of lending, if someone else can find lower cost of funds, and do so in a timely manner, get to it by whatever means, as long as it doesn't come with requirements that are onerous or other types of restrictions. Absolutely, there's revolvers all over the country, and some programs are better than others. Some, the waiting list is extremely long, others it's not. But if that type of money is accessible, then absolutely, because to me that's how it should be. I wish there was that type of instrument readily available to every water utility out there. And while it wouldn't allow us probably to participate in loaning into the water industry, it would certainly remedy this infrastructure need and really close the gap, the funding gap that's out there.
All right, great. Question from Dendra. Dendra asks, how do financing rates compare to SRF or USDA RD?
Oh, okay. So the SRF, state revolving funds, kind of hand in hand with Ronald's point about state revolvers. Because those are kind of subsidized, and they're just not going to compare in terms of the types of rates that other lenders are going to charge. So typically with those state revolving funds, USDA loans, they're very low cost and they're very long term. So again, great solutions if you can qualify for it and you have the accessibility that's needed in terms of the time. And I would say that the rates you're going to see from traditional lenders are probably, if you're getting 1.5 or 2 on those types of deals, you're probably going to see 3 or 4 in the commercial lenders. So it's impossible, to compete with a subsidized rate. I'm glad those monies are out there. I wish they were more readily available.
All right, great. Good question. Another question from P, and he asks, is a lending institution and municipal client who chooses installment purchase financing for a multi-million-dollar project negatively impacted by a low bid winning contractor's so-so credit?
So is there a negative impact when the contractor has so-so credit? Beth, am I interpreting that correctly?
Yep, I believe so. It says a low bid winning contractor's so-so credit.
Oh, okay. Well, a lot of times, I think the low bid. Well, put it this way: whenever I go see somebody, and they bring up the lowest bid, I always tell them, when I stepped on the plane today, I hope that Boeing didn't accept the lowest bid for the jet engines on the plane, right? Low bid is, the competitive bidding reason, but, getting to what's the best solution. And so if a contractor comes in and that contractor, he's the lowest bidder, but yet there's a somewhat of a checkered past there, or it's not as, maybe it's just somebody who just doesn't have the same credit rating as another maybe nationally recognized provider. It's a factor in the process, but it's a minimal factor, especially in a municipal situation. It's the municipality's credit, and there's a deferral of judgment that takes place from a lender perspective, where you say, you know what, they've gone through their process, they have their competitive bid requirements, they had vetted this, they chose that contractor because they felt that was the best solution for their municipality. So it's not our area to look at that and really have it manifest itself in the rate in any way, shape, or form. We're going to look at that particular municipality, their revenue history, and their current status, terms, reserves and those types of things. So I would say not really, although if I had a $20 million project and it was a company's first project, there would be a greater level of due diligence that would need to be done on that contractor. It's not impossible, but you'd want to know that contractor has the experience and the resumes and the staff and the experience to deliver a project.
All right, great. And we've got just two last questions here, both from Dendra. First one, it says, is this financing restricted to work on public property, or can it be used for work on private property? For example, lead line repair.
Actually, it can be used in both places. I'd want to understand the particular situation to see if there's any. Generally speaking, there shouldn't be any restrictions there.
All right, great. And last question for the day from Dendra also, is financing generally fixed to proper rate setting?
It's a good question, and I'd say the answer is no. It's generally fixed to the credit of the borrower, and while the credit of the borrower and their financial reserves may be a function of their rate setting policies, it's not tied directly to that. There is one thing that typically gets checked. If you have a municipality or an entity that has extremely high rates, they'll look at what the headroom is there for that rate. So in other words, if those rates are already extremely high, boy, there's a pain threshold that you end up hitting. And so that rate maintenance covenant that we talked about earlier, how much room is there to raise rates? And if they're already extremely high, then that would be something that would be taken into consideration. But for the most part, there's not a lot of discussion that takes place about your rates, how they were established, why they were established, why you charge what you charge. It's more about the bottom line profitability or revenue generating capability of the utility.
All right, great. Well, thank you, everybody, for all those good questions in there and some great discussion, I think. Brian, before we close this up, do you have any final comments or thoughts that you want to leave our audience with today?
No, I would just like to thank everybody for taking the time. We appreciate it. If you have any questions, my contact information is up here. Happy to help. Happy just to have a general discussion too. I look at the industry and I feel like our role is to just help provide information, provide solutions where we can. I like that state revolving funds and other alternatives were brought up because they're out there, and we all like options, and you have to know what your options are. It's not a one-size-fits-all, and so ask around and ask the questions, and by all means, don't be intimidated by the finance process, because it's, at the end of the day, it's your money you're spending.
All right, great. Well, thank you so much, Brian, and thank you for everyone who joined us today. And of course, thank you to our sponsor, Key Equipment Finance. Key Equipment Finance has been in the equipment finance business for more than 4 decades and is one of the largest bank-held equipment finance companies in the United States. Key Equipment Finance provides tailored equipment lease and finance solutions for commercial clients and government entities, which includes financing solutions for water utilities and public work departments, equipment manufacturers in the water industry, and engineering companies that are focused on water. Key Equipment Finance offers flexible financing for all types of equipment, including meters, water meters, pumps, filtration and treatment, and other water and wastewater products and services that help address problems caused by the nation's aging water utility infrastructure. We hope that you can join us for some of our upcoming webinars, including our Communicating the Value of Water webinar presented by returning speaker Melanie Getz on January 21st, exploring real-world tested strategies and solutions you can implement today in your public outreach programs to better communicate the value of water and change your public's behavior for good. our Backed by Popular Demand Voodoo Hydrology webinar presented by Andy Reese on January 29th, exploring the key elements, assumptions, and most common misuses of popular urban stormwater methodologies, as well as recommendations for proper application of each. Our Introduction to Russell II webinar presented by returning speakers Terrence Toy and David Lightly on February 25th, exploring the revised Universal Soil Loss Equation and how you can use Russell II to estimate erosion on your construction sites. And finally, our Designing Effective Sediment and Erosion Control Plans for Roadway Projects two-part mini-series presented by masterclass speakers Jerry Fifield and Tina Wills starting on December 10th, exploring proper design, completion, and assessment of roadway sediment and erosion control plans. Finally, make sure to check out our on-demand library with over 150 webcasts, including this webcast, which will be available for the next 12 months for you or for anybody who'd like to watch it, and our recent bestseller, Fluvial Geomorphology, presented by David Williams. All of these are available at foresteruniversity.net. And that takes our webinar to its conclusion today. Thank you, everyone, for joining us. And until next time, thank you and have a great day.